Okay, thank you very much. Welcome to the Avon Pension Fund committee meeting on Friday the 26th of March. My name is Bruce Sheeran and I'm the chair of the Avon Pension Fund. I would like to welcome all councillors, officers, members of the viewing public on YouTube to this meeting. My name is Bruce Sheeran, obviously chair of the committee. I will now call out the names of other members of the committee and ask them to confirm they are present. Councillor Sean Stevenson McGoll.
Present.
Councillor Chris Dando. Nope.
Councillor Dando might be late, Chair.
Right. Councillor Paul May.
Present, Chair, thank you.
Councillor Amanda Rigby.
Present.
Councillor John Cato.
Present.
Councillor Steve Pearce.
Present.
Councillor Toby Savage. No Toby?
Given apologies, Chair.
He has, okay. Councillor John Goddard.
Present.
Thank you. Charles Garish.
Present.
William Liu.
Present.
Richard Orton. Richard? Have we had any apologies, Mark? From Richard?
Sorry, I didn't know I was on mute. I'm present.
All right, okay. Thank you, Richard. Shirley Marsh Hughes.
Present.
Pauline Gordon.
Present.
John Finch.
Present.
And Wendy Weston. Thank you very much. Can I remind everyone to keep the background noise to a minimum and only to speak one person at a time and not to speak over others. Please mute your microphones when not speaking and then unmute when I invite you to speak. Please indicate if you wish to speak by using the chat facility on Zoom by typing MIS, may I speak, and I will call you and speak in turn. Should the committee need to take a vote in order to expedite the result, I will assume the majority position. So if you wish to abstain or vote against, please indicate on the chat when moving the vote. Does anybody have any questions? No. Right, apologies for absence.
So, Chair, just to cover off what we've been through, so apologies from Toby Savage and Mike Rumpf, and Councillor Dando, I think, intends to join us when he can.
Right, thank you, Mark. Declarations of interest? Any declarations? No. Any urgent business? There is no urgent business. We have now public councillor statements.
Yes, we do, Chair. Sorry to interrupt you.
Yeah.
We've got two statements from members of the public. Councillor Fodor from the Redland ward and Alistair Yule to give two statements.
Yeah, okay, thank you very much. Perhaps I can call on Councillor Martin Fodor first. Martin, if you'd like to make your statement.
Thanks very much, Chair. My statement is about risk, reputation and misrepresentation of the fund. In terms of risk, for investors, there's a serious risk of stranded assets as stocks based on expectations of continued extraction permanently lose their value when the fossil fuel minerals have to stay in the ground. So I'd like to know what analysis has the fund done of the recent price crashes and revaluations of assets in fossil fuel-based investments that it holds. How certain are you that you're not risking exposure to stranded assets? Secondly, in terms of reputation, other funds have already begun to divest their fossil fuel assets. And in January 2020, there was a headline given to Brunel Partnership that it had decided to carry out a stock take of its policy's effectiveness, but only in 2022, which is still a long way off. And that just delays the alternative approaches. It's not divestment, despite some headlines. It's and even putting some funds into lower carbon stocks isn't divestment or shifting of existing assets. Your June 2020 meeting showed that these greener investments had been more successful through the pandemic, but no increase was approved of them. Friends of the Earth and Divest UK show that your financial investment in climate breakdown is sadly quite typical. So there's a reputational risk, the risk that the fund represents local authorities who have all declared a climate emergency. But this stance is backed by the largest staff union, Unison, as you know, because they came to tell you last summer. Are you prepared as a fund for further scrutiny as the Paris commitments get left behind in the Glasgow conference this autumn? And finally, misrepresentation. In September last year, Bristol was credited internationally following a C40 Cities press release that claimed Bristol supports divestment. I'm wondering if the Avon Pension Fund was as surprised as me at this claim, given it's been blocking it for several years. The declaration calls for divesting and investing in action in the alternatives. But in reality, it's not a U-turn. Perversely, the text allows a cop-out, just encouraging pensions to develop a policy to invest in climate solutions. And Bristol only supports a policy to reduce fossil investments and increase sustainable investments. So no divest and no shift in the investments in large scale. But it does call for a clear timetable and a set of metrics to align with the Paris Agreement. I'd like to know if it's, because I think it's debatable whether you've actually got this clear timetable. Could you confirm you've got one? Finally, with 2 more years of inaction and monitoring spun us action to divest invest, an action repeatedly blocked by Bristol Labour over the last 5 years. I'd like to know if you should be divesting now, and if so, could you clarify, will you revisit the Brunel Partnership 2-year delay? Will you work on a target for net zero by 2030, which is what all your constituent authorities have actually adopted? Will you inform the workforce of options to shift the funds out of fossil fuels, say over a 5-year period, to highlight the benefits of this compared to the risk of stranded assets that I mentioned? And finally, will you follow the best practice of actually putting funds into new forms of positive energy investments like community energy projects and dramatically stepping up funding into cleaner energy, storage, smart systems, energy efficiency and diversification being tried elsewhere, like the new renewable infrastructure funds that are available? It's a climate emergency. Action is needed, not just headlines, especially misleading ones and ones that seem to misrepresent you. So I look forward to your response in the meeting today. Thanks very much.
Thank you very much, Councillor. You've asked a lot of questions there, so I think, and what I would like to do is for the officers to actually put a response to all those questions and send that back to you. Great. And also send it out to the members of this committee.
Thank you very much.
Okay.
That would be really helpful. They're all set out in my written submission.
Yeah, that's great.
I appreciate that.
That's great. So that's what we would do. All right.
Thank you very much.
Thank you very much. Next one is Alistair. Alistair? Hello.
Good
How
afternoon.
Are you?
Very well, thank you. Good
Right,
afternoon.
thank you very much. If you'd like to start.
Okay. Good afternoon, everyone. I'm Alistair. I'm the Baines Unison Branch Green Officer, and I'm submitting this statement today on behalf of the West of England Unison branches, including Baines, Bath Spa University, Bath University, Bristol, North Somerset, and University of the West of England. The September 2020 investment strategy statement states the Avon Pension Fund will use the fund's power as a shareholder to encourage change in the companies in which it invests to support the transition to a low carbon economy and align with the Paris goals. It also states that if engagement does not work ahead of the Paris stocktake in 2023, the fund will consider selective divestment from laggard companies. Please can the committee report on the following? Has the fund identified which companies in which it invests are engaging in fossil fuel extraction and fossil fuel energy production? 2. How is the progress those companies are making towards decarbonisation being measured? 3. Has the fund begun the process of assessing which, if any, of those companies will be considered for selective divestment ahead of the Paris stocktake in 2023, owing to their insufficient progress towards meeting the 2015 Paris Agreement? And 4, if that's not the case, when does the fund plan to begin the process of identifying these laggard companies? We emphasise that burning all the oil and gas from currently operating fields would take global warming beyond 1.5 degrees, and it is imperative to stop all new fossil fuel infrastructure and fossil fuel industry expansion. The company Shell, which we believe the fund is invested, plans to greenlight more than 35 new oil and gas projects by 2025, according to their investor presentation in June 2019. We also like to repeat the point we've raised previously, that there is a strong financial case for divestment from fossil fuels to avoid future losses. Studies show that fossil fuel use will peak in the 2020s, after which investors in the industry should expect significant losses. Increasing numbers of investors are divesting from fossil fuels purely on financial grounds. Divestment from companies that base their business model on fossil fuel extraction can be aligned with the fiduciary duty of the fund to scheme members. Thank you.
Thank you, Alistair. I'll repeat what I said to Councillor Martin Frodo, that there's lots of questions in there. We will get the officers to answer those questions to you, and they will send all the answers round to all the members of the committee as well, okay? And then I'm sure we will be coming back to this at the next meeting. Okay. Thank you very much, Alistair. Much appreciated. Right. Thank you very much. We'll move on to item 8, which is the pension board minutes. Do I have a proposer that we're happy with these?
Sorry, Chair, just to bring you back a step. It's the committee's minutes and their last meeting first before the pension board.
Oh, sorry. Yes, I've missed that.
That's all right.
Oh, sorry.
No worries.
Yeah, the committee. Are we happy with those minutes? Somebody speak.
I'll propose those.
Right. Thank you, Shirley. Right. Have I a seconder?
Second.
Right. Thank you, John. Everybody in favour? If nobody sticks their hands up and say they are, I think everybody's in favour. Then we move on to the pension board. You've had all the minutes for this. Are we all in favour of adopting these minutes? I went to the meeting and I thought it was very good. Okay, so I think everybody's in favour of that. We'll move on to item 9, which is the service plan and budget. Tony Bartlett.
Thank you, Chair. I think for this year's service plan, we provided quite a comprehensive picture of future activity of the fund over the next couple of years. Despite the challenges represented by the pandemic, I think the fund has achieved quite a lot. The transitions of assets has continued apace and will complete this year, leaving the fund to manage down some legacy assets We've continued to implement revision to the investment strategy, despite the need for the fund to take stock of its position some 12 months ago when the markets adversely reacted to the COVID outbreak. We've had progressed a number of projects, including the abortive exit cap, although the timescales for some of the other projects have been reassessed, and you'll see that reassessment in the appendices. And we're continuing to do some valuable work on governance, and continuing to manage the changes across the employer base. We've strengthened the investments team and commercial teams through some good recruitment, as we planned to in last year's plan. And we're continuing to fill the large vacancy gap in administration as well. I think I can say it's really been a testing time for managers and staff over the last 12 months of the Avon Pension Fund, and it has taken its toll, I'm sure, as it has of everybody here on the call today. But I think, the positive I'm taking out of this is that we are still moving forward as a fund and still progressing. Just looking forward over the next 12 months. So the council is actually rolling out some new laptop technology, including Microsoft Teams, and this should improve connectivity for all of the APF service and staff. There are also some planned changes to office usage, which will mean that we need to reconsider our working and operational arrangements and embed new ways of working once they've agreed. And this is expected to sort of take place in the second part of the year. We're beginning preparations for an interim valuation, and obviously the sort of valuation in 2022. And following an interim valuation, we'll be looking at the investment strategy and whether it will still be meeting our funding obligations. And also there is obviously some increased momentum in climate change activity and disclosures, particularly with the conference in Glasgow and the upcoming Paris stocktake as well. Probably the most significant area for us operationally has been the sort of move to home working and the digital requirements that is kind of highlighted to us. So we'll be undertaking a detailed digital review, which looks at better supporting our operations, our staff training and development, improving communications with our employers, and access to information for stakeholders. And a lot of that will form the backbone of a revised administration strategy, which we're looking to bring to the committee in the latter half of the year. I think to kickstart a lot of this, what we want to do is to provide some inward focus for the APF and strengthen the management, particularly to lead on this transformational work, and also separating out some of the project work as well, to ensure we've got some real focus on each aspect of the business, and a sort of high-level structure is appended as one of the appendices. Finally, we're probably aware that the Good Governance Stage 3 review has recently been published, and only this week the pensions regulator has announced a consultation on the revised code of practice, which codifies almost all existing practice, including COP 14, which governs the LGPS. We'll therefore have to take forward the implications of these changes to administration strategy and governance arrangements as they come through and we understand the implications better. So that's probably all I want to say by way of introduction to next year's service plan. I'm happy to take any questions, as I'm sure Liz and Jeff will be happy to as well.
Wendy?
Oh, thanks. Tony, just on page 53, the administration strategy is all on hold. I just wondered what the reason for that was.
Well, the administration strategy it's still live at the moment. So we've got an existing administration strategy, but the reality is that since we've gone into lockdown and we're operating largely from home, it has identified that we need to make quite significant changes to our technology requirements, the way we operate, the way we communicate, and we're looking at quite potentially a significant investment program to sort of fix some of these gaps. So what we're doing is reviewing the investment strategy as is, and we'll bring a revised proposition to the committee later on this year, and that will identify then any investment requirements to improve our technology position.
That's lovely. Thank you very much.
Okay, any other questions to Tony, please?
Yeah.
Yes, please.
Yes, John?
On page, find the page number, page 47, which is Appendix 2A, I can see a number of things in there which appear to be not explaining quite so clearly. Like the iConnect says that December 20 due March 22 now in progress, but it hasn't been labelled up as in progress behind schedule. So there are things like that. And the other thing that raised my question in my mind when I was reading that was, it's a big long list, but I wonder if well, it'd be helpful to me anyway, if it were able to be listed as a Gantt chart of some sort, so you could see it in the context of everything else. And it would also be helpful to understand who's responsible for the different components.
Yeah, this is
can be
this is clearly a summary of
governance terms.
Yeah, this is clearly a summary of a much bigger project document,
Yes.
which has got the responsibilities, and we can provide a Gantt chart on the specific one where we with iConnect. We've actually suspended rollout for a time because of COVID, and we've reactivated that over recent months, so hence the delay. But what we find is, because delays to recruitment and getting resource availability given the COVID situation, we actually rephased a number of projects there to give them more realistic delivery timetables, because otherwise they would all be showing red at the moment.
Yeah, indeed, because I was thinking that again, with COVID and people resource issues, it would be good to understand if quite a lot of the load is landing on one or two shoulders, and what we might consider.
And that's one of the reasons why we're looking to sort of focus some of the project work on a particular transformation team when it comes to the inward projects affecting the way the service operates, but also on a projects team to pick up the specific administrative regulatory changes which are coming in, because at the moment we're trying to deliver some of those within the business as usual. So we're trying to get some refocusing in as part of these changes now, to make sure that the specific business activities really do have some emphasis to take them forward.
So thank you for that, Tony. I just appreciate in future, more enhanced understanding for clarity.
Okay.
Thank you.
Thank you. Any more questions?
Chair, can I raise a point? I've put 2 MISs up on the chat, and it doesn't seem to identify where it's from. It's not identifying me.
Right, okay.
I don't know why that is.
Did you want to ask the question?
I do. I refer to paragraph 4.2, the main focus of the service plan. I'm surprised there's not a greater reference to staffing. The service plan needs to be taken forward by staff, and I would have expected, it's alluded to in point 2, but I'd expected a greater reference to staffing in that main focus. Which is the direction going to be in? Need to support staff training and recruitment practices, etc., etc.
Yeah, I think that's a fair point, and it probably reflects an omission on my part in writing it rather than the reality. We have been engaging quite a bit with staff on some of the digital issues which they are experiencing, and communications issues, and also the operational problems which will feed into some of the improvements that we want to make going forward. There are regular meetings between staff and managers, to look at overall development needs. We have put in place training officers to support training and development of staff, and we're looking to consolidate those within this budget as well. So staff are very much at the forefront. Perhaps it's just not reflected very well in the document.
Well, can I just ask, can it be better reflected in 4.2 as one of the main focuses?
Yes, we can. I think if we could, probably best to reflect it in the minutes that, you know, staff will be at the heart of you know, the engagement and changes as we go forward. Yeah.
Okay. Any other questions, please?
Chair, can I
Yeah,
ask a
there's
question?
various in there.
Yeah, there's quite a list, Chair. I think, yeah, Shirley is
Chair.
first this
I
year.
can't see any. There's nobody coming up on MIS.
Okay, Chair, we've got Shirley next, then Pauline, and then Councillor McGall.
Right.
Thank
Right.
you. Thanks. Thanks. And Tony, I'm really supportive of the strengthening of the resource and the management team. But in the budget, 22-23, we increase salaries, and then they go down again in 23-24. And I'm just wondering whether we're giving ourselves enough scope for the extra projects and business that's coming down the line, and whether we ought to have that increase for a longer period in the budget.
Yeah. Can I defer that one to Jeff, who's got the detail on that?
Okay.
Hello, Shirley. Hello.
Hello.
Hi there. The part of the budget, or part of the fact the budget looks as if it's reducing in 23-4 is because we are looking potentially to inflate the budget to cover off resource to support McLeod. At the moment, we don't know the time frame for implementation of the remedy. So it may well be that one of the options open to us is to go out to the market and maybe recruit more resource to cover McLeod off. So we should know that in the course of the next year. If that isn't the case, then we won't necessarily need the additional budget for next year that's been reflected, I think, in the accounts there.
Right. So is that to cover the McLeod potential?
It's mainly the McLeod and the time span.
Yeah. I would just err on the side of caution in terms of how long that's going to take to deliver. So, you know, just give yourself some flexibility, I think, in terms of how the timeline for that.
Oh, yeah, certainly. Yeah, I mean, I think it's a situation that we have to keep live. And obviously, there's a bit of an unknown around this at the moment as to time. Yeah.
Okay, thank you.
Thank you. Chair, can I just come back on
sorry.
Sorry, I do apologise. Can I come back on the point I think that was made at the very beginning by, I think it may have been Wendy, on the admin strategy. The current admin strategy is not completely suspended. It's just some elements of it that are suspended, not the whole admin strategy. So I didn't know if that was clear.
Right, thank you. Thank you, Jeff. Pauline?
Yeah, my question was quite similar actually to Shirley's, but I also had another one which was just really understanding on page 50. You have two lines under Committee and Pension Board. One, develop online portal for PC and LPB members, and I just really wanted to understand what that was and if it's different to the one below and just how it's different. And also the one's in progress and the other one's behind schedule. I just wanted to understand a bit about that.
So the online portal for members is something that we've been looking into now to provide access to committee papers and other papers for members of the pension board and members of the committee as well, and also to act as a repository for just updated information. Now, some of that relates to the changes which we proposed back last year, I think it was the beginning of last year, to the way that we were going to operate the governance of the committee and the pension board by actually trying to take some of the common information off the committee's agenda to make them much more strategic, but still to circulate and be able for members to be able to access all that information. So we're still working on that at the moment, hence the delay.
So is it different to the one below?
So
how is it different to the one below?
it shouldn't be different to the one below. No, I think it's Modern Gov is actually the name of the system we're using. I think what we were looking at was potentially looking at something separate because Modern Gov has got some functionality issues. But no, it is the same actually.
Okay.
Okay, Pauline. Sean.
Yep.
Thank you much, Chair. There was a couple of things I wanted to mention. One was specifically with regard to 4.2 as on page 28 in terms of the service plan. And I just wonder if we could have a bit more detail about the stakeholder communication strategy with regard to our investment strategy in climate change, and whether officers feel that we are front loading enough resource in terms of officer time to ensure that we can ensure that we have better communication both with our employers, members, and the wider population of the 4 local authorities in which we serve, because we're getting a lot more, as we saw for today, a lot more communication and engagement with those stakeholders, and they all have a place to play in terms of their views on how the pension fund should be investing for the good of society, members, and those employers. And I just wonder if you could give us a bit more detail whether you think the resource allocated in the plan is sufficient.
Well, I think at the moment we have sort of recruited into those communication roles at the moment. So we've got a new member of staff who's been working on some of those communications, as actually Sean, we've discussed with you as officers, really. You know, one of the challenges we've got is about getting sort of social, media take up. So we are looking at how we can use social media and things like LinkedIn to get the messages out, and we are working on a plan to sort of, to implement some of that and to use that to basically tell the rest of the world and our employers what we, the Avon Pension Fund, are doing. I think that's the big missing, isn't it, Mum? Because we do a lot, but we don't broadcast it very well. So we are looking for ways to broadcast it and improve that. I think as the impetus for climate change accelerates now over the next few years, we'll have to keep it under review and potentially may consider strengthening that area as well. But I think part of the issue is we need to be able to have something to say, and which attracts attention and attracts media attention, and that's been one of the challenges going forward. So I think at the moment, I think we're probably in a reasonable place, and certainly work that has been done to examine what other funds are doing would suggest that we do put an awful lot more resource into these areas, whereas quite a number of funds are quite silent on this. So I think it's a yes for the time being is the answer, but it's something we need to keep under review.
Thank you very much, Tony. And my second point was just to thank you and the office for team. I've been working home for just over a year as well, and it has ups and downs. And, I think all of us, really appreciate the hard work that all your colleagues are doing in the pension fund administration side to ensure that our staff, especially, are supported well enough to continue to be able to do their best from working from home. Thank you.
Hear, hear.
Thank you, and all of the staff appreciate the support that the committee give them. It's well received. Thank you.
Okay, any other questions? No other questions. The motion is that we approve the point.
We've got
Chair.
Sorry,
there's quite a few.
Sorry, Chair. I think we've got.
Sorry,
Councillor.
I'm not getting any.
That's okay. That's okay, Chair. I'll try and keep a track on it. Councillor Paul May's next.
Right. Okay.
Sorry,
Paul.
I really wanted to reinforce what Councillor Stevenson McCall said. I think in view of the pandemic, to see this report as comprehensive and effective as it is, as a committee, we should feel proud of the work the officers are doing under very, very difficult circumstances. And at the appropriate stage, Chair, I would like to move the recommendation, because I think it's a great credit to everybody that they've got this far in producing this document. Thank you, Chair.
Thank you, Paul. Anybody else to speak?
Chair, no, I think you're clear now.
Oh, right. Thank you. I've got a motion to approve by Paul May. Do I have a seconder?
I'll second that, Chair.
Sure. Thank you, Sean. I'll presume everyone is in favour. If not, please use the chat, which I can't see at the moment. Okay, so we're all in favour of that. Thank you very much for that. We'll move on to item 10, which is Treasury Management Policy. And Liz, please.
Chair, it's Dave Richards here, the Finance and Systems Manager. So on the Treasury Management Policy, the committee approves the Treasury Management Policy annually following the Council's adoption of their Treasury Management Policy. There are no changes to the actual policy that was agreed last year in March 2020. I'm happy to take any questions on this Treasury Management Policy.
Okay, thank you. Are there any questions?
I've just got a question, Chair.
Thank you, Shirley.
Hi.
If you would.
Yeah, you said it hasn't changed, and maybe I've missed it from previous times. And I know it's a policy that the council approved, but I was surprised to see the property fund there in the counterparties that we might invest in, because I think this is about short-term investment of our monies, isn't it? Rather than, and I just wanted to make sure that was an appropriate asset class to invest in.
Yes, so the property fund is a form of investment that's very similar. Our access to it acts very much in the same way as a money market fund,
right,
which we use extensively anyway. And those are very liquid assets. So it would be the same as a money market fund, essentially.
That's fine. It just, when I first saw it, just highlighted, that's all.
Yes.
Thank you very much. Thank you.
Fair enough. Yep.
Thank you, Shirley. Any other questions, please? Yes, Sean.
Thank you very much, Chair. My question is with regard to Appendix 2 and the list of UK banks that we use for unsecured investments. My question was, obviously locally within the Avon Pension Fund area in Bristol, we have Troodos Bank, which is HQ'd there. And I just wondered, where does because I'm very interested in creating sort of like wealth locally within the pension fund, and as a local authority as well as administering authority, where does that bank come with regards to the ratings for UK banks, and has the council, Bath and North East Somerset in this counts, because we're following their rules, considered that bank previously?
Yes, I would probably have to get back to you on that question unless Liz has got an answer.
Yeah, I was going to say I haven't actually ever heard a conversation with them about that, so we'll definitely ask them whether they've first of all considered them, and if not, why not. And there might well be a good reason. It might be that it's not a big enough, it hasn't got a big enough deposit base or whatever, but we will find out and we'll come back to you on that one.
Thank you very much.
Okay, Sean. William.
Thank you, Chair. The policy as it is okay, and thank you, Shirley, for asking that question on property fund. It's interesting. Can I just ask David, whether the council and the pension fund really, because the policy is very similar, behind the background is thinking about what happens if interest rates go negative?
Yeah, I might have to defer to Liz on this one as well, actually.
Yeah. It's not designed to catch you out, because it is a very difficult thing. Yeah.
I think I think for us, what we use the Treasury management for is very, very limited to our working balance, so that we can always pay our pensions and any payments out of our NatWest account as quickly as possible. So I think whereas the council have they have that their Treasury management policies covering that aspect, but also more medium and longer term investments. We generally don't leave long-term investment with the Treasury management team, but it will be an issue at the moment on any of our euro deposits, for example, that we have at our custodian bank, State Street. Doesn't get it has a negative interest rate, so they actually don't really want us to give them euro deposits. So we will have to manage the deposits even more closely. But what we try and put any other than short-term money that we need for working purposes, we try and put in the liquidity strategy that mirrors our investment strategy, and And that's how we try and get around that. But it is a real issue, and it has been obviously in the year.
Potentially, yeah. Okay, thank you, Liz. Thank you.
Thank you, William. John? John, you're on mute.
Thank you very much, Chair. Thank you. On Appendix A, the risk register, I noticed that item, I think it's R28, recruitment of staff. We've got a number of higher risk scores, but that one seems to be the most critical. How confident are we that we're going to be able to keep on track with all the other things?
So I think that's the next
Chair,
item.
that's the next item, Chair.
That's the next paper.
Is it? Oh, I apologise.
Yes, we're on the Treasury management paper.
It's on the
item 10.
Appendix A of this one, I thought, Treasury management. Have I gone too far?
I think you're like me, John, when I went a bit far on the minutes.
In that case, I apologise, but I'll reserve that question for next time around.
If you would. Any other questions? Okay, being no other questions, I'd ask the committee to approve the Treasury management policy. Do I have a proposer?
Happy to propose, Chair.
Seconder, please.
Happy to second.
Seconded.
Thank you very much. Okay, so I see nobody voting against. So we will move that. Right, John, we're annual review of risk management and register. Caroline, please.
Okay, thank you, Chair. So this is the annual review of the risk register. Appendix A is a comparison of all risks showing the position in March 2020 and then again in March 2021. Over the period, we have added one new risk concerning COVID and the sustainability of the remote working arrangements. Over the period, 10 risks have increased in their score, some of which were also affected by the uncertainty caused by the pandemic, such as investment returns, the financial stability of employers, and the service we were able to deliver to members. Over the period, 4 risks have decreased. I would say here that the risks have not gone away, but we believe that the mitigating actions taken have reduced the risk. For example, climate change remains a high risk, but we believe that due to the measures we've taken in our investment strategy, we have been able to slightly reduce the risk score. I have highlighted in the report some further detail about the increased risks and the mitigating actions that have resulted in some risks decreasing. The full risk register and dashboard can be found in Appendix B and C. Happy to take any questions. I don't know if John wants to ask his question again there.
Please, John. If you would, John.
I will. Yes, it was the question around the resourcing that we have, recruitment of staff and the issues around that, and the other risks that we've got on the risk register and how much they might be impacted by that issue. So I was trying to understand where we are on that and what might need to be done, if anything.
And I think the recruitment risk, I don't know whether Jeff wants to add anything to it, but the recruitment risk has been kept at a high level right the way throughout because it has stayed difficult to recruit. I mean, I think we are now actually making some progress, even though we're having to do the recruitment remotely. We're starting to make good progress, and we've seen several new members of staff join the fund over the last sort of few months. Jeff, I don't know if you wanted to add to that.
Yeah, certainly, Carolyn. Yeah, just to back up what Carolyn said, really, as you recall, back last year, the committee voted in favour of the recruitment of some temporary resource, I suppose, to put some training into the administration, and that's worked really well in enabling us to have a a three-phase approach on trying to recruit the vacant posts that we have, which were around about 11 or 12 posts at the time, bearing in mind to over-recruit too quickly would place a massive burden on the administration. So we've had a plan in place which has been operational since the beginning of the autumn, end of the summer last year. That's worked really well. I'm just going to come on to that later, but we are kind of managing the risks through that by a gradual introduction into the department of new staff, getting them trained up, and then being able to pass them over onto the teams without placing too much burden. So we're managing that risk pretty well, I think, the best we can in the circumstances. Certainly the training roles have proved invaluable, I have to say. So thank you.
Thank you, Jeff.
Thank you. I'm aware how much you're all doing and how much you have to do under these situations. So thank you.
Thank you, John. Paul?
Thank you, Chair. There's been a lot of talk recently in trade magazines about the FCA and its future role. I see risk 42 sort of makes reference to that, but shouldn't this actually be on our risk register? If the FCA is done away with or changed significantly, it could affect this pension fund.
Shall I answer that one, Chair? I think you're probably right. We'll wait and see what the potential changes are. Clearly, there'll be an impact on Brunel for those changes, and that is probably the most significant area. But it's then any sort of follow on then, which impacts on the way that particularly the investment side operate, I think, within the fund. Now, an awful lot of that is already delegated, but there could be more in the way of governance and scrutiny coming through from changes to the FCA. And yes, so I'd agree. We probably need to sort of just flag it on there as one to watch, I think, going forward.
Thank you, Chair.
Okay, Paul. Pauline.
Hi, thank you. It may just be me not reading the chart properly, but I just wondered why the trend box is filled in Appendix B, and they're all flat. They look like they haven't changed, whereas when you're looking at the first table in A, you're seeing risk going up at the top.
Yeah, the difference, Pauline, is the comparison over the whole year. So that's showing a trend over the whole year, whereas on the risk register, in the whole risk register in Appendix B, that only shows movement from one quarter to another. So it just means that from last quarter to this quarter, there hasn't actually been any changes.
Okay.
I think that was one of the reasons why we wanted to do an annual comparison, because that was then, it shows a little bit more sort of movement over the whole year rather than just over a quarter.
Yeah, brilliant. Thank you.
Thank you, Shirley.
Thank you, Chair. And thanks, Caroline. I was just a question really about the change in the risk sort of ratings, if you like. And instead, I think it's number R23, the financial stability of employers. We've moved that from possible to likely. And we've also got it as a high impact of the scheme overall. So I suppose I'm wondering whether is that the right rating for that particular risk, and if so, should we be actually having some kind of reporting in terms of what we're doing about that, where the issues are and what we can do about them?
Okay, I believe we have got a report later on employers. Liz, is that correct?
Yeah, we're not really talking about the covenants this time. That was actually at next meeting in June. But I think across, all of our employers have much greater financial pressures on them now.
Sure.
So
yeah.
I think we're thinking about looking forward and thinking, how are we going to be able to manage in any way any increase in contributions that might be needed into the fund at the next valuation, etc. So we're trying to be forward looking. We're not actually saying that we've got employers that are about to go bankrupt on us. It's not that. But I think the likelihood of having financial of that impacting the fund, because we might have to, for example, I'm not saying we would, but lengthen deficit recovery periods or whatever. So that's how we're thinking it's coming through. It could end up coming through in terms of what we're thinking about for the next valuation, which is why we're doing quite a lot of preparation work ahead of it. But it's a very difficult one because, you've got, they're very, possible, likely.
I know.
It's really difficult to and then over what time frame, anything to do with the employers and liabilities is over an incredibly long time frame.
Yes,
so it's the immediate 12 months either. So it's just trying to use it in a common sense way, I suppose.
Sure. I just think where you've got something that's high impact and likely to happen, we just ought to be showing that we're actually doing something, and you probably are behind the scenes. So
yes, and that's why we'll be taking that. We'll be covering that when we do our interim valuation, and then the preparation ahead of valuation. What do we have to think about? We've already started to think about when we should be having all these meetings with employers and everything. So there's a huge program of work behind it. Yes.
Yeah. Okay. Thank you.
Any other questions?
Charles Garris, please, Chair.
Charles. You're on mute, Charles.
Yeah, right, got there. Chair, R47 on page 75. I'm not sure whether this has been overtaken by the recent announcements from the governments to freeze this change. This cost cap mechanism.
Jeff, can I ask you to come in on this one?
Yeah, thank you, Carolyn. I think although the cost cap, is it the cost cap? Sorry, I can't really read what it says.
Yes, it's the implementation of changes arising from the scheme cost cap mechanism that's gone up to high possible and going up to risk 12.
Yeah, so the cost cap is not the exit cap; it's the cost cap that you're referring to. So that's being unpaused.
Oh, that's the difference. No? Sorry,
so it's not. Yeah, it's not the exit cap, Joel.
My mistake. Sorry.
Okay. So I couldn't read it. I've got the wrong glasses on.
Thank you, Charles. Any other questions, please? Okay, so I'd like to ask the committee to note the annual review and risk management register. Okay, are we happy with that? Yes, I think so. Nobody said no. Chair. Okay.
Thank you.
And thank you, Caroline. Item 12, Brunel Pension Partnership. Liz?
Thank you, Chair. So this is our routine update that is actually for noting. There's no issues that we've raised with the committee here. The last Brunel Oversight Board meeting and actual AGM was actually held yesterday. So after I've made a few comments, I'll ask Tony maybe just to update on anything from there. So the transition stage, as we said, is finally drawing to a close, and it's so the focus is now very much more on how we report, or how Brunel reports back to us, the clients, on general communications. More, we're putting in place what the client communication should look like for the next year. So that would be, the investor engagement days that we've held in the past. They've held for us in the past. So we're beginning to plan all of those things. And then the other big focus, obviously, is the project to look at how we can, how Paris aligned our portfolios are, or how we have, what's the gap analysis and how do we get them to that point. So that's a big piece of work that they've already started on. And I think that during the year, while we do our equity allocation review, that some of that work will start to come through, even though quite a lot of it will be put into the stock take that we are going to be having in 2022. But it's a massive project, and there's an awful lot of gaps still. So there's still a lot of work that has to be done to be able to give us a good analysis. So again, we should, in terms of reporting, the actual client committee reporting, we should see changes in that later on in the year. Again, there's a big project going on. They've got a project manager to actually lead it, to take it forward. But any changes will have to be implemented. And if that means that they have to get different suppliers to do that sort of work, it could all take a while. But we are definitely moving away from the transitions and into the business as usual. And at the June meeting, or definitely at the September meeting, we'll be able to give a full and final position on where we are with transitions. I think that the key thing is that there's been quite a lot of special shareholder reserve matters that have been considered in the last few months with Brunel, and those have all been approved. So it's been quite busy as well, interaction with our shareholders and BOB members. So I'm happy to take any questions on the paper. I'm happy to take questions in principle about anything in the exempt appendices rather than have to go into the exempt appendix, unless it's something that should be discussed in exempt, obviously. So I'll leave that up to you, but I'm happy to take questions. But I thought, first of all, if you want to move, I can see Charles has got a question, but is it about what I've got to talk about, or is it about Bob and AGM? Because I was going to move that to Tony.
It's on page 84, Liz.
Okay, that's fine.
Hang on, is it in exempt? Do I have
it's
to
not
move
in exempt,
into
no,
exempt?
no, it's not in exempt.
Okay,
No,
that's
my
fine.
question is fairly straightforward, especially in the light of what you said just now, that Brunel are proposing a 3% increase.
Yeah.
Now, my concern is, how is that going to be absorbed by the pension fund?
Well, it's a 3% increase in the annual budget. So for us, it's only, we only do about their budget is about 10.5 million, and we are about 12% of that budget. So that is already in our service plan.
Yeah.
That cost has been included in the service plan you just approved.
So the fund is going to absorb that increase.
Yes.
Yeah.
And that's the budget that has been approved by the clients, the shareholders for Brunel, actually addresses a significant number of issues that were client driven. So we wanted much better reporting. We wanted them to put more resources to responsible investing, because the climate change and just the responsible investing agenda is so huge, and it takes a lot of engagement work, not just on those issues, but also with clients. So, Brunel are helping us do all our climate disclosure statements and everything like that for all 10 funds. So, that's an awful lot of work. So that was definitely something that is needed. And then the last thing that we wanted more resilience in the private markets team. They are now I think managing about 5 billion of assets. And so there's a very big risk. It's a very small team. They do outsource a lot of the work, but they are still the experts that are the ones that are making the decisions about where our assets should be invested. So there is a lot of risk around that. So in fact, the amount of extra that they put into the budget is very low, given those three significant strategic demands of clients. But they actually made quite a lot of savings in other areas, where either due to COVID and the fact they haven't done so much travel and training, and other areas that they've also saved. So I think the BOB and the shareholders were very pleased to approve the budget on the basis that it was very much addressing quite strategic concerns of the clients.
Sorry, can I come in now, please?
Yes.
Thank you. It's just on page 98 when you were saying about the budgets and the underspend, especially in training. I mean, yes, you can understand about travel and expenses. A little concerned about perhaps just rolling it over and possibly reviewing the reduced balance for training, because obviously there must be some leeway for professional development within that training budget.
So you're talking about Brunel's?
Yes.
One of the things. Yeah, no, they have still got a very big training budget, but they used to go to lots and lots of conferences and training abroad. So it's just like us, not abroad, away from the office. It's just like us. Our training budget has just not been used. We're still doing training, but we're doing it all virtually. So you're not all,
so there's no reduction in training as such.
Yes, no, they are. It's just the sheer costs of actually getting or doing the training. We, as a fund, we're getting an awful lot more free training because they can't really charge us for just sitting looking at a Zoom screen, can they? So yes, no, they're not cutting down, but obviously, just like us, also they haven't been able to actually do as much because just the sheer demands on you working through COVID and trying to work remotely.
Oh no, I appreciate that.
Yes, but they are. I think that they've sort of like put back in 2/3 of what they would have had this year, so they are still got a big training budget, but their travel budget's been slashed quite significantly, which is, I think, quite a positive in lots of
very much so.
Yeah,
that's lovely. Thanks very much, Liz.
Yeah.
Okay. Any other questions for Liz?
If not, can I ask Tony if he wants, or Bruce if you want to make a comment?
I'm happy just to do a little bit more of a general update on some of the changes that's taken place there. Changes at the Brunel board. The shareholders did agree to change the board structure, which effectively shifted the balance of power to 5 non-execs. We've appointed a new shareholder, Ned, who's Liz McKenzie, has got vast experience in sort of building societies and financial services sector. 2 further non-execs did resign, which wasn't unexpected, and they have been successfully recruited too. But as the sort of recruitment process is being finalised, I sort of can't sort of divulge the names yet. They've not been made public. David Vickers as well has been appointed as the new Chief Investment Officer, and he does seem to bring a great deal of solidity to the role as well. He's been very good in sort of all of the engagements that we've had with him so far. On the Oversight Board, Ray Theodolu, who is the Oversight Board Chair from Gloucester, is stepping down. He is not standing in the next election, and he has been replaced by Robert Gold of the Environment Agency, who's taken over as Chair. And some of the work that has been done by the Oversight Board on the governance review has resulted in agreed performance review process for the Chair of the Brunel Board and the shareholder, Ned. And that performance review was actually undertaken by on the chair of the board this year. As a result of that review, the chair was actually voted back in at the AGM yesterday. Special reserve matters are something which all of the shareholders have to agree in order to vote through any changes to some of the governance arrangements there. And the timescale for that has been reduced from 20 working days to 10 days, which pretty much reflects the nature of the working arrangements now as moving to online. The government review is now entering its final stages. The shareholder agreement has been updated primarily for lots and lots of technical issues, which have been signed off after sort of 12 months worth of deliberation by the legal people. So that's made some good progress. Also at the AGM yesterday, the annual report was signed off by shareholders. The remaining Ned was reappointed, as was the chair, and the auditors were reappointed as well. So it's been quite a busy period, as Liz says, for the Oversight Board and Brunel and officers really in taking forward quite a number of changes, I think, to the shareholder agreements. And just on the budget, just to go back on to what Liz said about the budget and some of the increases there, and effectively the budget is remained, although it's a 3% increase, it's remained fairly flat. It's around the 10 million mark and has been for a number of years. So, you know, Brunel have been readjusting their finances as the organisation evolves, really, and that's set against the backdrop of managing up to 30 billion now. So, you know, it is a very small number compared to what they're having to manage, really, and increasingly they're getting towards that 30 billion figure. Okay, that's happy to take any questions.
John?
Just a quickie, Chair, just to enforce something that Tony mentioned about the new Chief Investment Officer, David Vickers. I've met with David separately on one of my other things. Seems a good guy, and I think is a good recruit for Brunel.
Yeah, thank you, John. Any other questions? Okay, I'd just like to say in the meeting yesterday, I think I was one of the most positive meetings I've been in Brunel for a while now, and I think we're going in the right direction. I think that stability is the word which is going to carry us over the next year or so. And I think that's what we need to do. If there's no other questions, then I would ask the committee to note the Brunel Partnership update on pooling. Are we all happy with that? Right, thank you very much. We'll move on now to item 13, investment panel activity. Nathan.
Yeah, thank you, Chair. So Brunel presented to panel at their last meeting on Cycle 2 private markets portfolios and their intentions for Cycle 3. Based on that presentation and following advice from Mercer, panel approved the top-up of the existing Cycle 2 commitments in line with the strategic allocation weights. I guess just for context, over the last quarter, capital's been deployed at pace, particularly in the secured income portfolio, where just over 140 million has been called in the last month. And this is coming off the back of increased acquisition activity and the fact Brunel are now at the front of investor queues for the long lease property funds. And that's all I had to say, so thank you. Any questions at all?
Any questions?
Chair.
Thank you, Sean.
Can I just thank members of the investment panel for their very detailed questioning of officers at the February meeting of the investment panel to go through this in detail, and hopefully the rest of the committee can be assured that the members, yourself, Councillor Dando, and our 3 independent members, do scrutinise our officers and our professional advisors from Mercer's at all these meetings and ask very difficult questions on your behalf. So thank you to everyone for their contributions back in February.
Okay, thank you very much. If there's no other questions, thank you, Nathan. And I will note that we note the investment panel activity. Number 14, investment performance strategy monitor. Nathan again, please.
Thank you. So just a couple of points for noting, and then I'll hand over to Stephen Mercer to take you through the performance report. So the first one was Hsbc Engagement. So this is the replacement of the shareholder resolution with a board-backed resolution, committing Hsbc to a series of near-term decarbonisation targets. So it's been seen as a very significant win for investors, and I hope to be able to share the outcome of that vote with you all at the next meeting. The second point I had here was the fact we're going to be publishing our annual carbon metrics report next quarter, and this report is going to include an analysis of the weighted average carbon intensity of our equity investments, as well as detail relating to direct and downstream emissions, reserves and fossil fuel subsector exposures. Yes, that will be presented at the next meeting. Elsewhere, Brunel are assisting the fund and officers on reporting obligations, particularly around the TCFD and the new FRC stewardship code. So I just wanted to mention that. Unless there are questions on the covering report, I'll hand over to Steve. Thank you.
Any questions? Okay, Steve.
Okay, thanks. So in terms of an update from a performance perspective, I think it's important to remind everyone of just what's happened over the last year or so. So this time last year, the funding position had fallen to about 84%. But since then, we've seen sort of a big rally in markets and a big bounce back. And as at the end of December, the funding position has bounced back to sort of 95%, which means it's on track. So given what happened last year, I think that seems a pretty good outcome. And the key theme for me now is that things are ticking along nicely, in the sense that we have a constructive view on most asset classes that are expected to deliver sort of long-term growth. And we've seen the fund benefit from that in sort of recent periods. The underlying assets have performed well. It's been pleasing to see some good levels of outperformance across the board for the sort of Brunel portfolios. Always good to get off to a good start. We've also seen positive contribution from the currency hedging policy as a result of sterling strengthening. And we do think that is very much connected to the vaccine rollout in the UK versus other regions. With regard to the equity protection, because of rising equity markets, the value of the equity protection has come down a little bit. But it's important to sort of note that the equity protection has behaved exactly in line with expectations and continues to serve as a very important role in the overall strategy. And work is continuing at pace for the next iteration of that. And as the equity protection sort of rolls off in 3 tranches this year, we'll be sort of implementing that dynamic protection, which will evolve more as conditions in markets ebb and flow. So overall, there were no new issues that we thought needed to be raised with the committee in terms of strong areas of concern. It's been a pretty sort of low key but positive period recently.
Thank you, Steve. Any questions for Steve, please? John Cato.
Hello, yeah, just a question. You probably already answered this one before, but I'm looking on this report, investment performance, A performance 5.1. It says that we have a 3.2% net investment return over the quarter. Can I ask, was any of that to do with further new contributions going into the fund, or was that all in terms of performance on the fund?
So, John, I don't know the detail about how many contributions were invested, but that return would come from the performance monitor. So if contributions were invested, that would be a sort of total return, so including the performance of the assets and any contributions.
And the new contributions.
Yeah.
So it's a combination of the two. So
just to clarify, we generally on a monthly basis do not have monthly contributions to invest because of the way our contribution flow comes through the year. So it does take into account, though, the net cash balances or the change in the net cash balance as well. So the way that they X all of that out, and so it is fundamentally the asset performance, for the performance of the assets that are invested at any point in time.
Thank you for that. Thank you for that clarity.
Okay, John. Steve.
Yes, thank you, Chair. This isn't one for Steve, actually. It's I want to talk about responsible investment, and I wonder if it would be possible to have initially a short report, because I don't want to expend a great deal of officer energy on this at this point, unless we start uncovering things that we need to know more about. But I'm concerned about some of the talk that we hear on our news channels about human rights abuses, particularly in China. And I note that Chinese state officials are beginning to become very vocal in condemnation of what they view as Western interference in internal affairs. And they're looking to boycott many Western consumer goods companies, businesses in China. So I wonder if we might have an assessment of implications for the S bit of ESG, particularly in relation to China, but more generally as well.
Yes, Steve? Okay. Do you like the answer to that, Steve?
Yeah.
Was that one for me?
Yes, I think so. Or it could be for anybody, tell you the truth.
Shall I start? I think it is something we've actually talked about it with Brunel to a certain extent, and we also did some analysis ourselves, well, earlier this year, in fact, of what our exposure was to China at that point in time, obviously only. And I think the real big problem of it is the fact that so many global companies are interacting with China. So it is just a really difficult one to get a real handle of what the exposure is. But I think from a strategic risk point of view, it would be something that we should look to try and get some analysis of. So if I take that off stream and talk to Mercer's, I think that'd be a way forward and bring back to committee.
Yeah, I think that would be very helpful, Liz.
Yeah.
I mean, it's something that we need to be aware of. It's something that we certainly don't want to be ambushed by activists over and suddenly find we haven't done enough to answer questions. There are potentially significant issues around sanctioning of individuals and businesses in China by Americans and even by our own government. So initially, really, I think I'm looking for a paper that flags whether this is something that needs more work or whether it's something that we don't need to. My suspicion is that we probably are going to end up doing a sizable chunk of work on here. I see an awful lot of geopolitical issues coming down the track from the Far East, and those will have economic implications. And it would be quite nice to be out ahead of the train, or be able to sidestep the train when it reaches the end of the tunnel.
Yeah, thank you, Steve.
Mixing my metaphors as always.
Can I just come in there, please, Chair? Because I think Liz is right. We have kind of touched on this before and sort of examined the kind of exposure we have. I think Liz's point is valid, that it's the indirect exposure that we're really unsighted on. So I think that we can sort of draft a bit of a position on where we think we are, but I think it's that indirect exposure which will only come to light as things emerge, I think, really, and it's a position we'll probably have to keep updated.
I mean, if we're invested, for instance, if we're invested in American markets, I would imagine it would be Apple would be one of the investments that would be unavoidable. And I imagine that an awful lot of their assembly and sourcing is done in the Far East.
Yeah.
In fact, I know it is. So, which companies are actually directly engaged in sourcing materials from slave labor camps, whether they're going to get sanctioned, whether an assessment has been done on how soon China will invade Taiwan and disrupt chip supplies. I mean, it does go on. I know I'm shroud waving here, but there are serious implications about this. I mean, Volkswagen are talking about going from a 3-shift system to a 2-shift system because they can't access chips. So I'm just putting it out there so that we can have a look at it and then determine what we may or may not wish to do.
Certainly, we could bring a paper to the next meeting, Steve.
Yeah, perhaps a chapter of that might address our level of exposure to Chinese markets.
Yeah, that's fine.
Purely on a governance basis.
Yeah. Okay.
Thank you.
Okay, thank you very much. Any more questions, please? For Steve? Okay, so the investment performance monitoring, I would ask the committee to note this and take on board what Steve has put forward, that we actually try and produce a paper to highlight the risk of dealing with countries in the Far East. Okay, so are we all in favour of noting this? Okay, thank you very much. Number 15, update on legislation. Can I invite Kate to speak, please?
Yes, thank you, Chair. So regulatory update has been included in the papers for noting, and this gives you the position on key issues as at the end of February 21. So there's been some key developments since December on the restriction of exit payment regulations to update you on. As you know, these regulations came into force in November last year and restricted the total cost an employer could pay to a member exiting the scheme to £95,000. On the 12th of February, the government issued directions which disapply parts of these regulations with immediate effect. This means that the exit cap no longer applies for anyone leaving on or after the 12th of February. And as such, a member who is dismissed on grounds of redundancy, for example, who is over the age of 55, can once again receive a fully unreduced pension, regardless of the cost to the employer. The guidance on the directions further set out HM Treasury's expectation that employers should pay any additional sums that would have been paid had the cap not applied for those employees who left between the 4th of November and when the regulations came into force, and the 12th of February when they were removed. Thankfully, we did not have any cases during this period where the cap was exceeded, so there's no requirement for us to carry out a rectification exercise in respect to this. We do, however, understand that the government will look to legislate again to tackle unjustified exit payments, and that a revised cap could be in place by the end of this year. MHCLG will also launch a further consultation on the changes required to the local government pension scheme regulations as a result. Moving on to the latest position with McLeod. So whilst a response to the HM Treasury consultation to remove unlawful age discrimination in the unfunded public sector schemes was published in February, we continue to await a response to the MHCLG consultation on changes required to the LGPS. We understand that they'll make a written ministerial statement shortly, outlining some key remedy policies, and a full consultation response will follow later this year. On the 15th of February, the Scheme Advisory Board published a Good Governance Phase 3 report, which provides further details on some of the recommendations that were included in the Phase 2 report, including the requirement for a single named LGPS senior officer who's responsible for the delivery of LGPS activity for a fund, and also introduces further requirement for key individuals such as pension committee members and Section 151 officers to have the appropriate level of knowledge and understanding to carry out their duties efficiently. And finally, since this paper has been produced, I think Tony mentioned earlier, TPR have launched its consultation on the introduction of a new single modular code. So the new code will merge the existing codes of practice that the regulator has in place, including Code of Practice number 14, which is the current code of practice for public service pension schemes. And we're in the process of reviewing the details of the consultation and will respond in due course. I'm happy to take any questions on anything else in the paper.
Thank you, Kate. Shirley?
Thank you, Chair, and thank you, Kate. It's a question on the cost management process. I know that we're still waiting for clarification there, but do we have an idea that if the same approach is taken with our scheme as with the unfunded schemes, whether the actual cost threshold will have been breached in the 2019 valuation, and therefore we will have to do some work?
Yeah, it's unclear at the moment because we're still waiting for directions from Treasury as to how they're going to include the cost of McLeod in when they review it, and the Scheme Advisory Board will follow that guidance. And so at the moment, we're unsure as to whether it's likely to have an impact either way. But I believe that we'll probably follow HM Treasury, whereby if the ceiling is actually breached, then there won't be any kind of detrimental impact on members' benefits. I believe we'll follow that line.
Yeah.
But we still don't know yet, I'm afraid.
Okay. And just to follow up and for reassurance on the exit payment legislation, are we absolutely clear that where there's no cap, the employers are accountable for the actual take-up of any strain on the fund on exits?
Yeah, they will be accountable for full strain costs. I mean, we didn't have any cases, thankfully, so
no,
we've been able to recover full strain costs in all cases that we've had anyway. But yeah, that is clear that employers have to pay the full cost now.
Yeah. Okay. Thank you.
Thank you, Shirley. William.
Thank you, Kate, for a very good paper. On the question of McLeod, obviously, as you said, the government has announced the TPS remedy. And so in university, about half of staff is in TPS and the other half is in Avon Pension Fund. And obviously members are wondering what is going to happen for Avon Pension Fund, which I keep saying that, look, nothing has been published yet. My question is the government is putting 1.5 billion aside to address the TPS problem. Are they going to put some money aside for the LGPS problem? Do you know?
We're not aware that they will be.
Okay.
No, unfortunately.
Okay.
I would imagine
Thank
the
you.
answer is no, to be honest, William. Given the track record of government support for the LGPS over the last few years.
Yeah. It's their error, not ours. Anyway, thank you.
Thank you, William. Any other questions for Kate?
I'd just
Thank you, Richard.
like to make a comment, Chair.
Yeah.
In my view, the handling of the exit payments has been a complete shambles. One arm of government doesn't know what the other arm's doing. So the exit payments were introduced without the adjustment to the pension regulations for the local government fund ever being approved. And this all started off in 2015, 2016. They've had plenty of time to actually get it right. So I hope when it's brought back again, it will be done properly and not disrupt the lives of employees and employers.
Thank you, Richard.
Chair, can I just come back on that? Because I think, one of the missings in the whole exit cap saga and even in the cost cap mechanism debacle as well was kind of the role of the scheme advisory board in that. And I think what the government have recognised now in DCLG is there needs to be sort of closer working with the scheme advisory board on bringing these issues forward so that all of the ramifications are properly understood before they just launch into some new legislation. I think that discussion is ongoing now.
Okay, any other questions for Kate? No, we're being asked to note the decision, and I will approve that the committee note this. I hear nobody against it, so we will note that one. And we will move on to number 16 to Julia, please.
Chair, I'm just going to introduce it,
right.
this one, but I will defer to Julie if there's any questions. But so just to let you know, this is part one, as I say, of two papers that we're bringing to you with a funding and employer update. In future, we will just give you the one paper in the June meeting, and that will then capture all the year-end work that the pension fund does around employers, etc. So this paper is really just to give you a flavour of the type of issues that we're having to deal with and how we monitor and manage employer risk in a more general way. So firstly, it shows that we've got policies in place that we need to put policies in place to respond to all the changes in the regulations. And where we don't have the full regulations in place, i.e. the McLeod remedy, etc., that we do have, we've agreed policies as to how we're going to deal with those and take them forward. Because, for example, when employers exit, we don't know what the McLeod costs are going to be, but we have to obviously make sure that they are paying what we think their liabilities are going to be. We also have an awful lot of routine employer work going on with exits, new admissions, and we have over the years really increased the robustness of the admission agreements that we've got in place, etc. And lastly, there's an awful lot of employer-led decisions or events that we have to deal with. And we also have employers, some of our smaller ones, that are just naturally getting nearer to exiting simply because they only have one or two active members left. So we're trying to make sure that they understand the implications of that, and we start to plan and put things in place to help them through that process. And obviously, the introductions of defined deferred debt agreements and fixed payment plans under the regs will make that a slightly more easier process for some of these employers when they do need to exit. So in Exempt Appendix 1, we give you a flavour of some of the work that we're working on. Some of them are material in terms of the sheer size of the liabilities, or material to the fund in terms of the liabilities, but others, they might not be material to the fund financially, but they are obviously really material issues to those particular employers. So we have to work with them each and put as much time into all of them to make sure we get to the best solution for both parties. And then obviously, depending on each one, there are then implications for the admin team in terms of having to process member records as a result of any decisions that are made. So if there's any general questions, including in principle on the subject, the information in the exempt appendix, I'll take it in open session, but I don't want to obviously talk about any of the employers or any of the issues per se, any of the situations per se in the exempt appendix, unless we'd have to go into exempt session for that. So happy to take questions.
Yeah, Shirley, please.
Thanks, Chair, and thanks, Liz.
Is this exempt or not?
No,
it's
I
just
don't think it is.
question.
No.
Thank
yeah.
you.
It's just a broad question, Liz. I know you've put some information there about discussions that are ongoing. Where employers have to get actuarial or legal advice, who pays for that advice?
Well, we always, our policy is that we charge our employers if it's employer driven. So anything that we have to do, so for example, if they need termination estimates or anything like that, we obviously, they pay for that. But what we do try and do is, if we have to get advice ourselves around the issue that informs the fund and makes sure that we are doing things properly from a risk management perspective, we pay for that. But anything that is directly because of their event and it's for them, they pay for it. And that's the same with everything, whether it's audit, actuarial issues, legal issues, we always do that. And likewise, if any, as a result of even the DDAs and the fixed payment plans, although we can do them under the regulations going forward, there will be a cost to them and they will have to be picked up by the outgoing employers.
Yeah, okay, thank you, that's clear.
Thank you, Shirley. Any other questions?
Yeah, can I raise a question, Chair?
Yes, Richard. This is not on the exempt, is it?
It is on the exempt report.
Right. Okay.
Do we need to go into exempt then, Richard?
I need to go into exempt.
I think we
let's
may
go into exempt. Yeah, let's go into exempt.
Okay. The panel, having been satisfied that the public interest would be better served by not disclosing relevant information, proposes in accordance with the provisions of section 100A(4) of the Local Government Act 1972 that the public should be excluded from the meeting for this item of business because they're likely disclosures and exempt information is defined in paragraph 3 of part 1, the schedule 12A of the Act as amended. So, Mark, if we can